Imagine this. You wake up one morning, check your phone, and realize you've made money while you were asleep. Not from a side hustle, not from a job, but from your money quietly working for you. Sounds like a dream, right? Well, that's exactly what investing is. It's your money clocking in for the night shift. But here's the catch. Most people never get to experience that because they think investing is only for rich people, math geniuses, or Wall Street guys in suits yelling, buy, sell all day. Wrong. Totally wrong. By the end of this video, you'll know exactly how to start investing, even if you've never done it before. I'll show you what investing really means, where to start, how to avoid losing money, and how small habits today can make you a millionaire later. And trust me, when you see how just $10 a day can turn into over $1 million, you'll never look at your coffee budget the same way again. All right, let's get started. What investing really means and why it's not just for rich people. Let's clear up one thing right away. Investing isn't gambling. It's not throwing money into something random and hoping for the best. Gambling depends on luck. Investing depends on time, patience, and smart decisions. Think of investing like planting a seed. You don't see results the next day, but with time, water, and sunlight, that seed grows into a tree that keeps giving fruit. When you invest, you're not just buying something, you're owning a piece of something, a company, a building, or a fund that earns money even while you're doing nothing. Now here's the secret they don't teach in school. Saving alone won't make you rich. Because while your money sits in a savings account growing at maybe 1%, inflation is rising around 3% or more every year. That means your money is actually shrinking in value. It's like standing on an escalator that's going down while you're trying to walk up. You're working hard but still going nowhere. Investing flips that escalator around. Suddenly, it's carrying you upward, even if you move slowly. Why most people never start investing? So if investing is so powerful, why doesn't everyone do it? 3 reasons: fear, confusion, and procrastination. First, fear. Most beginners are terrified of losing money. They hear stories about crashes, scams, or people losing everything in crypto, and they think, nope, not for me. But here's the truth. Losing money temporarily is part of investing. It's like lifting weights. You'll feel sore at first, but that's how you grow. If you zoom out and look at history, the stock market has always gone up long term, even after wars, recessions, and pandemics. From 1926 to today, it's averaged around 10% per year. That's insane growth if you give it enough time. The second reason, confusion. Most people think investing is complicated, full of weird words like diversification, liquidity, or derivatives. But 99% of successful investors stick to simple strategies. You don't need a finance degree, you just need to know a few basics. And the third reason, procrastination. People always say, I'll start next month when I have more money. Then next month turns into next year, and suddenly 10 years are gone. Here's something wild. If you start investing $200 a month at age 25, by 65 you could have around $800,000, $1 million, assuming average market returns. But if you wait just 10 years starting at 35, you'd end up with around half that. That's the power of time. Every year you wait, you lose some of the magic. The magic of compounding, how your money makes babies. All right, here's where the magic really happens. Compounding is when your money starts making more money, and then that money makes even more money. Think of it like planting a tree that grows more trees. Let's say you invest $1,000 and earn 10% a year. After 1 year, you have $1,100. The next year, you don't just earn 10% on your original $1,000, you earn it on $1,100. That's how it grows exponentially. If you keep it going long enough, it snowballs. Here's a simple breakdown. After 10 years of investing $100 a month at 8% return, about $18,000. After 20 years, around $60,000. After 30 years, roughly $150,000. After 40 years, over $300,000. All from just $100 a month. That's the power of compounding. It's like your money gets a second job while you sleep. This is how the rich get richer. Not because they're smarter, but because they start earlier and stay consistent. The simple 4-step beginner plan. Now I know what you're thinking. Okay, sounds great, but where do I actually start? Let's keep it simple. You only need 4 steps. Step 1, set a goal. Ask yourself, why are you investing? Is it for retirement, financial freedom, a house, or just to stop living paycheck to paycheck? Having a goal gives your money a mission. Step 2, build your safety net. Before investing, make sure you've got an emergency fund, ideally 3 to 6 months of expenses. Life happens, jobs change, cars break, stuff goes wrong. You don't want to sell your investments early just to pay bills. Step 3, choose your platform. These days, you can invest right from your phone. Apps like Vanguard, Fidelity, Charles Schwab, Robinhood, or Webull let you start with just a few dollars. Don't overthink the platform. What matters is that you start. Step 4, automate it. The secret weapon of long-term investors is automation. Set up an automatic transfer every month, $100, $200, whatever you can afford, into your investment account. Treat it like a bill you can't skip. That way, you invest consistently without thinking about it. The problem: everyone wants to get rich fast. Now let's address the elephant in the room. Everybody wants quick money. We live in a world of instant gratification. 2-day shipping, viral fame overnight, and people turning $500 into $50,000 in crypto. But here's the harsh truth. Those stories are the exception, not the rule. For every person who made it overnight, there are hundreds who lost everything. Real wealth isn't built in a week. It's built over time. It's like going to the gym. You can't work out for 10 hours straight and expect six-pack abs. You get them by showing up every day for months. Same with investing. If you focus on get-rich-quick moves, like day trading, meme stocks, or chasing hype, you're gambling, not investing. The people who truly win are the ones who stay patient when others panic. The exploration, your investment options, explained like you're 5. Let's break down the main types of investments in plain English. 1. Stocks. A stock is a piece of a company. Buy one and you own part of that company. When the company does well, your piece becomes more valuable. Over time, the US stock market has returned around 8 to 10% per year, but it goes up and down a lot in the short term. 2. ETFs, exchange-traded funds. Think of ETFs as baskets that hold lots of different stocks. Instead of betting on one company, you own hundreds or even thousands at once. For example, an S&P 500 ETF owns shares in 500 of the biggest US companies, like Apple, Microsoft, and Amazon. 3. Index funds. Very similar to ETFs, but you usually buy them directly from an investment company. They're super low cost and perfect for beginners. Warren Buffett himself recommends index funds for 99% of people. 4. Bonds. When you buy a bond, you're lending money to a company or the government. They pay you back with interest. Not as exciting as stocks, but more stable. 5. Real estate. You can buy property to rent out or sell later. Real estate can be powerful, but it also takes more cash and effort. 6. REITs, real estate investment trusts. Don't want to buy a house? REITs let you invest in real estate through the stock market. You can own small pieces of shopping malls, apartments, and office buildings without the headaches. 7. Retirement accounts, 401k, IRA, Roth IRA. These are special accounts that help you invest with tax benefits. For example, a Roth IRA lets your money grow tax-free, and when you take it out later, you keep every penny. The climax, the $10 a day secret that changes everything. All right, this is the part most people don't believe until they see it. Let's play a quick game of what if. What if you invested just $10 a day, that's the price of a fancy coffee and a muffin, into a simple index fund that earns about 10% per year? Here's what happens. After 10 years, around $63,000. After 20 years, around $229,000. After 30 years, about $660,000. After 40 years, over $1.5 million. That's not lottery money. That's math. You didn't win anything. You didn't inherit anything. You just consistently invested a small amount and let time do the heavy lifting. And here's the thing. Most people waste that kind of money every month on stuff they don't even remember buying. Streaming subscriptions, snacks, impulse Amazon orders, they add up. The difference between rich people and everyone else isn't how much they earn, it's what they do with what they earn. That's the real secret. Real life example, Sarah's $50 a week habit. Let me tell you a story. Sarah was 22 when she got her first job. She didn't know anything about money, but one day her friend told her, just invest $50 a week in an S&P 500 index fund and forget about it. She thought, whatever, I'll try. She didn't check the market every day. She didn't panic when it dropped. She just kept adding $50 every week like clockwork. Fast forward 20 years, she logs into her account and boom, it's worth over $150,000. Same job, same paycheck. But while others spent their money on takeout and shoes, Sarah's money quietly multiplied. She didn't time the market, she didn't trade stocks, she just started early and stayed consistent. That's it. That's the whole game. The mindset that separates winners from losers. Let's get real. Investing isn't about picking the perfect stock, it's about mastering your emotions. When markets crash, most beginners panic and sell everything. But the best investors, they stay calm, or even buy more. It's like a sale at your favorite store. When everything's 30% off, you don't freak out, you buy. The stock market works the same way. When prices drop, good companies are literally on sale. But emotionally, it's hard to see that because fear takes over. To invest successfully, you need 3 things: patience. Good things take time. Consistency. Invest regularly, no matter what. Discipline. Don't let fear or hype control your decisions. That's it. No secret formula, no magic app, just human psychology and time. The time in the market rule. There's a famous saying in investing, time in the market beats timing the market. You'll never predict the perfect time to buy or sell. Not even the pros can. Studies show that if you missed just the 10 best days in the stock market over the past 20 years, your returns would have been cut in half. Half! So instead of trying to jump in and out, just stay in. Even if you invest during a bad year, time smooths out the bumps. The longer you stay invested, the higher your chances of success. Imagine a roller coaster. If you zoom in, it looks wild. But zoom out and you'll see the track steadily climbs upward. That's the stock market. The emotional roller coaster of investing. Here's what usually happens. You start investing, you're excited. The market dips, you panic. It goes up again, you feel smart. It crashes, you swear you'll never invest again. A year later, it recovers and you regret selling. Sound familiar? That's every beginner's journey. But once you realize that market drops are normal and temporary, everything changes. Historically, every market crash has eventually been followed by a recovery and new highs. Every single one. So instead of fearing the dips, expect them. They're part of the game. The exploration, how to actually pick investments. All right, let's get into some practical stuff. When you open your investment app or account, you'll see thousands of options. Don't freak out. Here's how to narrow it down. Option 1. Index funds or ETFs, best for beginners. If you want to set it and forget it approach, this is the way to go. These funds own hundreds of companies, so you're automatically diversified. For example, the Vanguard S&P 500 ETF, VOO, or the Schwab Total Market Index Fund, SWTSX. They're low cost, low stress, and historically perform better than most actively managed funds. Option 2. Target date funds. Great for retirement accounts. These are like autopilot investments. You choose your target retirement year, say 2050, and the fund automatically adjusts from risky to safe as you age. Perfect if you don't want to think about rebalancing. Option 3, individual stocks. Higher risk, higher reward. If you want to buy specific companies like Apple, Tesla, or Google, that's fine. But only do this with a small portion of your portfolio, like 10 to 20%. You'll get higher highs and lower lows, but it's a fun way to learn. Option 4, real estate or REITs for diversification. If you have more capital, real estate can give you rental income and appreciation. But for most beginners, REITs are an easier entry. No maintenance, no tenants, just passive income. Dollar cost averaging, the boring strategy that wins. Here's a strategy that beats almost everyone: dollar cost averaging. Instead of trying to guess when to invest, you invest a fixed amount every month, no matter what the market's doing. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, it averages out. It's simple, automatic, and proven. Even Warren Buffett, the world's greatest investor, says most people should just dollar cost average into index funds for decades. And the best part? You don't have to think. You just keep going. The buy and hold power play. If you take nothing else from this video, remember this: the stock market is a device for transferring money from the impatient to the patient. Warren Buffett. That's it. The people who constantly trade, chase trends, or panic sell end up losing. The patient ones who buy and hold for years end up winning. If you'd invested $10,000 in the S&P 500 in 1980 and did absolutely nothing, by 2025, you'd have around $1.1 million. No timing, no guessing, just time. That's the power of patience. The psychology of money, why your mindset matters more than math. Here's something most finance channels don't talk about. Investing isn't really about money. It's about behavior. It doesn't matter how smart you are if you panic every time the market drops. There's a great book called The Psychology of Money by Morgan Housel, and one of my favorite quotes from it is, "Financial success is not a hard science. It's a soft skill where how you behave matters more than what you know." That's so true. Investors who control their emotions make way more money than those who try to outsmart the market. So instead of trying to be perfect, focus on being consistent. Common beginner traps to avoid. Let's go rapid fire through some classic mistakes that wreck beginners. Checking your investments every day. The more you look, the more emotional you get. Check monthly or quarterly, not daily. Investing money you'll need soon. Only invest money you can leave alone for at least 3 to 5 years. Chasing hype. If everyone's talking about a hot stock, you're probably too late. Ignoring fees. A 1% management fee may sound small, but it can eat away hundreds of thousands over a lifetime. Putting all your eggs in one basket. Diversify. Don't bet everything on one company or one type of investment. Not having a plan. Random investing equals random results. Set goals and stick to them. Selling in fear. Market drops aren't losses until you sell. Hold tight. The power of financial automation. If you take one action from this video, make it this: automate your finances. Set your paycheck to automatically. Pay your bills, add to your emergency fund, invest a fixed amount every month. This way you remove human emotion, the biggest killer of financial progress. Automation builds discipline without effort. You don't have to think, you just win by default. Why the poor stay poor and how to escape. Let's talk mindset again, because this one's huge. Poor people focus on income. Rich people focus on assets. Income is what you earn. Assets are what earn for you. If your money only comes from your job, you're trading time for cash. But once you start investing, your money starts working while you're sleeping. That's the ultimate goal: freedom. And that freedom starts with a single step: your first investment. What if I told you that your money is losing value every single day you leave it sitting in your bank account? Yeah, doing nothing with your money is actually one of the riskiest investments of all. Today, I'm breaking down exactly how beginners can start investing. the right way, without confusion, scams, or needing a finance degree. By the end of this video, you'll know how to make your first real investment step by step and how to avoid the biggest mistakes that keep most people broke. Let's start with the truth. Nobody teaches us how money really works. School skips it, and social media either overhypes or oversimplifies it. But investing isn't some secret club. It's just learning how to make your money work for you instead of you working for it. Imagine you have $100. You could buy a nice dinner, sure, but if you invest that same $100 wisely, it can grow into thousands over time, all while you sleep. That's the power of compound growth. Albert Einstein supposedly called compound interest the eighth wonder of the world. Here's what that means. If you invest $100 every month and it grows at 8% per year, in 30 years you'd have over $140,000. That's without doing anything fancy, just consistency. But before we jump into where to invest, you've got to understand the foundation, your financial base. Step 1, build an emergency fund. This is your safety net, cash for when life punches you in the face. Experts recommend 3 to 6 months of living expenses in a high-yield savings account. That's not investing, it's protection. Without it, one car repair can wipe out your progress. Step 2, kill high-interest debt. If you've got a credit card charging 20% interest, paying that off is literally a guaranteed 20% return. No stock can promise that consistently. Step 3, start small, start early. The biggest mistake beginners make is waiting until they have more money. The truth? Time beats timing. $1 invested at 20 grows way more than $10 invested at 30. Now let's talk about types of investments you can start with as a beginner. Stocks. You're buying tiny pieces of companies. When they grow, so does your money. You can buy individual stocks like Apple or invest in groups of them through ETFs, exchange-traded funds. ETFs are perfect for beginners because they spread your risk across many companies. Bonds. These are basically loans you give to governments or companies. They pay you interest, and at the end you get your money back. They're generally safer but slower to grow. Real estate. You don't need to buy an entire house. You can invest in REITs, which are companies that own properties and pay you rent in the form of dividends. Index funds. These are like baskets that track the stock market. The S&P 500, for example, has 500 of America's biggest companies. Historically, it's grown around 10% per year on average. If you had just invested $1,000 in the S&P 500 in 1990, it'd be worth over $24,000 today. But here's where most people get stuck: fear. They think, what if I lose money? Or what if the market crashes? Here's the reality: markets crash all the time, but they also recover every single time. During the 2008 crash, the S&P 500 dropped by over 50%. If you'd panicked and sold, you'd have lost big. But if you'd stayed in, your money would have doubled in the next decade. So investing isn't about timing the market, it's about time in the market. Introduce a problem challenge. Now let's be honest, investing can be overwhelming. There's jargon, scams, and people on TikTok shouting, "Buy this coin now." You might wonder, how do I know who to trust? That's the challenge every beginner faces: information overload. One wrong step can make you lose money, or worse, lose confidence and quit altogether. So here's how to cut through the noise. First, learn the basics of risk. Every investment has a risk-reward ratio. Higher returns usually come with higher risk. A safe savings account might earn 4% a year. Stocks could make 10% or drop 20%. Your job is to find your comfort level. Second, automate your investing. Set up automatic transfers so a bit of your paycheck goes into your investment account every month. It removes emotion and builds consistency, like brushing your teeth, but for your finances. Third, diversify. Don't put all your eggs in one basket. A good rule of thumb is the rule of 100. subtract your age from 100, and that's the percentage of your money you could keep in stocks. So if you're 30, 70% in stocks, 30% safer assets. And please avoid FOMO. Fear of missing out makes beginners chase hype. Crypto coins, meme stocks, hot tips. Those are gambles, not investments. Let's make this real. Meet Sarah, a 25-year-old teacher. She starts investing $200 a month in a low-cost index fund earning 8%. By the time she's 55, she has $300,000. But her friend Jake waits until he's 35 to start. He invests double, $400 a month, and still ends up with less money, around $270,000. That's the magic of compounding. The earlier you start, the less you have to do. Now imagine your money as tiny workers. Every dollar you invest hires one more worker. The longer they work, the more they produce. But if you keep your money idle, those workers stay unemployed. So to wrap up, here's your beginner roadmap. 1. Build your emergency fund. 2. Pay off high-interest debt. 3. Start small but start early. 4. Stick to simple investments like ETFs or index funds. 5. Automate and stay consistent. 6. Don't panic during downturns. You don't need luck, you just need time and discipline. Now that you know how to invest, check out the next video for more investing content.